In this video, learn why one trader at our firm thinks Tesla is going to tank. Hi, I'm Mike Bellafiore, co-founder of SMB Capital, and we're a proprietary trading firm located in Midtown Manhattan. And I'm also the author of the trading classic, One Good Trade, and the playbook. In this video, see a firm prop trader share his thesis, supported by research and price action, on why Tesla is more likely than not going to tank.
We're back again to talk about another longer-term swing trade that works pretty well. I wanted to talk about some of the components that went into it. They're a little different. Definitely some fundamental elements, but more market understanding than understanding an income statement or a balance sheet, I think. So I called it shorting valuation and expectations. There's a lot of components that went into Tesla's meteoric rise last year. One of the strongest performing stocks in the market, up sevenfold last year, and entering into the S&P 500 on December 18th at over $800.
And it's going higher, Trey.
And it's going higher. I mentioned in one of the slides, where is it? Right there, skepticism. Shorting this, I will confess to have shorting this a little bit on the way up, but really didn't fight it because the story was so strong.
Well, you think this is going down, right? You think this is overvalued?
I think that this is very heavily owned and, yes, exceedingly highly valued. I will get into that in a moment. And yes, this is a short call where I think some of the components that led to a 7x increase are going away, and there's real opportunity on the downside. So yes, that is correct.
And I'll just share the context with you, which is, so one of our partners, Steve Spencer, has been really long for a really long period of time and has announced that if Tesla gets above 1,000, that he's retiring. So he's a huge bull on Tesla and the trade to the long side. So really interesting to hear another perspective, and perhaps even your perspective was at the time you thought it was time for a pull-in or up too much. But look, if you think it's going to 20, then love to hear that as well. Yes.
So it's going to 100. Actually, 160 will be the next stop.
He's never going to retire then.
He should have gone at, we almost made 900 if he was at 900 instead of 1,000. But he loves what he does, right? He doesn't want to retire. I'll talk to a couple of things, and I'm curious, very curious to hear if he watches this video. It's very highly valued. And people, when I started talking about this internally, I got some of the exact feedback that you're referencing is, it's going higher, and it's been a mistake to be short this stock for years. Elon is an incredible entrepreneur and has built an amazing company that is literally changing the world. But everything has a value. And I'll get into that in a little bit, in a couple of slides in a little bit more detail. I'll just lay out a number of components that went into the strategy here. But just valuation is part of it. But most people will tell you, you should know, you never short just valuation. You need something else to get the stock going in a different direction. So that's really very much is why now is the components of this thing, the thesis. ARK we'll go into in a minute. It's a very large fund with a very concentrated position that has had a very dramatic fund flows over the last year. I've seen different numbers, but they're consistent with something along the lines of going from $3 billion in assets under management at the beginning of last year to over 50 right now. That is very difficult to navigate. She runs a fairly concentrated fund and did not increase her number of holdings. So she just, the 10% of the ARKK flagship fund has always been in Tesla. And that's one thing when it's 3 billion, it's another when it's 50.
Totally different business, right?
It really, really, really is. I dealt with that personally, and it's very difficult to drive. I constantly use the aircraft carrier analogy. It's difficult. The Tesla is an easy story to short with the concentrated position there, with the vulnerability, and given that it's what I call a story stock, meaning that people aren't buying it for today's earnings. They're buying it for earnings farther in the future. This makes it more vulnerable to the increase in interest rates that we've seen because you have to discount those earnings over a longer period at a higher interest rate. So just think about a zero coupon bond being more subjected to changes in interest rates. It's the same concept.
Trey, when you say it's an easy story to short, do you mean because, hey, we've got one of the big buyers who really wasn't prepared to be able to handle the additional capital and is sloppily just throwing some more capital into what may have been a smaller idea, or do you mean something else?
I mean that, and there's a number of components. There's a lot of ways that he can go wrong, and it's basically the next bullet that I have in here is expectations are very high. That makes it easy to short. How is he going to exceed expectations at this point?
Gotcha. Okay. So that's the reason why you think this is a short, which is expectations. It's priced to perfection.
Absolutely, that's the best way to put it. Is absolutely priced to perfection. Then you also have increasing competition. There are a lot of EV stocks. When we were talking about EV stocks a year ago, it would have been Tesla, and I can't even think of any others. Now it's NIO, Nikola, Blink, CVCC, or whichever one, that SPAC that just bought Lucid. There's a lot more opportunities for investors to invest in the theme, as well as Audi, Ford, GM. Everyone is introducing electric vehicles. So they're getting competition both for the stock and for the product. So that is, I saw as a headwind for the stock to continue to outperform as well.
If you want to learn 3 real-world setups that our traders use, including the simple setup that we teach all of our new traders and the setup that turned one of our traders into a 7-figure big money earner, check out the free webinar that we're currently running. Just go ahead and click the link that should be appearing right now at the top right-hand corner of your screen. That's going to open up this free registration page in the new window. So don't worry, you're not going to lose this video. You're going to learn more in a couple of hours from this trading workshop than from years of online education.
I'm going to talk a little bit. There's a few big components here, and this is the valuation I'll talk about. It's absolutely a market darling. People love Musk. People love what he's doing. He's exceeded expectations for a long time. But when people start saying valuation doesn't matter, that's hard to believe. Eventually it matters. I would argue this is as stretched as I've seen since the late 90s. There's other times when similar concepts get bid up very highly and they do eventually return to earth. So I'm going to walk in the specifics on the valuation. On a price to revenue basis, at $800, it's trading at 24 times revenue. I have a number of others in here below. The only one that's even close is Shopify, which is 47 times revenues, but it has over double the gross margin. I point to gross margin because a company like Shopify or Roku or any of these others I have down here, they can scale their operating margin up much higher when they have that gross margin. Tesla has a gross margin of 21%, already the highest in the industry, 400 basis points above Toyota Motors, which is arguably the best manufacturing company in the world. But when you just think about the product, very simply, they make cars. That has a very high variable cost component, and you just cannot scale the margins that heavily. If you have a Netflix or something like that, yes, they have infrastructure and some things like that, but every additional subscriber that comes on contributes to growing the growth, levering the fixed costs. You can't do that. The business model is just fundamentally different. So to the bottom bullet, this is something else where expectations, it's priced very highly on outlook, and then I would argue expectations are considerably too high. So right around the time that this started coming apart, Kathy Wood was on CNBC, and she said that she thought the EV market share is going to compound at 82% for 5 years. And just a little bit of math, that's 20-fold. It's currently 1.8% of the market, EVs. That would take it to 36% in 5 years. That is very difficult. Tesla's own projections, which are on the next slide, she's 30 percentage points above their own projections, which are extremely difficult. Understanding how the cars are made, you can always get more steel, you can get more leather, you can get more components to build a car, but you can't get more car driving batteries. That is what looks to me like the bottleneck, and it's pretty widely discussed that this is something that they need to scale. And this is a slide from an article I read, which was talking about how aggressive these projections are. They have to build these factories. They have to get all the materials. There's rare earth metals and components that go into there, which are hard to mine. And Tesla's own projections are to grow 52% per year for 8 consecutive years. And that's very difficult to accomplish there. So for arguably the largest bull on the street to be 30 percentage points above what they're expecting, and then the stock to be expensive on those metrics, it just really, really, really looked priced to perfection.
So Trey, one thing that struck me was when you said they are just a car company. There will be Tesla bulls who will say that they are not just a car company. What say you?
So yes, I agree. They make the Powerwall, they make other products. They can do over-the-air software, but at the end of the day, their product output is a vehicle. They are going into different markets. I read somewhere that they're doing a joint venture where they're making 3D printing of, I can't even remember what it was. But anything like that is way too small and way too far on the horizon to be factored into the valuation currently. And what I'm really talking about, yes, they're changing the world. I've had these arguments. They're interesting, and I find them kind of funny. I don't mean to be dismissive when I say that. It's just at the end of the day, what comes off the assembly line is a car company. You can say it's software, you can talk about autonomous, you can talk about things like that, but they have to produce a car to get paid. That's how I respond to it. Dell, the slide I brought up right now, is relevant. I had this discussion back in the late 90s where people said it was a technology company. In reality, with full benefit of hindsight, what it really was is a very good supply chain company. They made products that were associated with technology. They grew like crazy. So looking at the far right screen, the stock was up 236%, 38%, 180%, had a pullback. Then what is that? 6 or 7 years of 200, 200, 240, and was priced to perfection. In the late 90s, everyone said it was a technology company. They made a technology product, but when things changed, the stock declined by 66% in 2000. It did rally a little bit in 2001 and bounced around for a couple of years, but eventually was taken private and came public again. But valuation does matter even in these stocks that grow to the sun. And we have seen this movie before. So I show that just to say it is possible and a market darling can decline by a considerable amount. Let's talk about the bigger picture. It was a huge winner in 2020, up 7-fold.
I will just sort of say, because you've upset plenty of people who are watching this by saying that they're just a car company. And so I will just say to you that there are people who share your opinion.
Yes.
There are lots of other people who would see a bigger potential product line and company for Tesla. They might see it as more of a energy company that can do a lot more than what it's doing right now. They could see it as a technology company that can do a lot more. And I won't get into that. And maybe Steve will even follow up with some thoughts about this. But even acknowledging, putting that on the table as a trader, this is super helpful to understand. If you're really long Tesla, like what you're saying is out there, and there are hedge funds out there that are saying this as well, and we got to know that. And then on the other side, this is the reason why the stock is up so much, which is people see this as much bigger than just a car company. It certainly couldn't hold its price if a majority of the people were seeing it just as a car company. So
those are
I think these are great conversations. But to the people that we've upset who are watching this, we're going through this exercise to understand the different players who are positioned in this stock. And so you'll make a really good you'll do a really good explaining why some people think this is a short or a pull and trade.
Some of the discussions I've had is that you have to think a company is bad or is flawed or I don't mean to be dismissive when I say it's just a car company. I'm looking at the components that are going to drive the margin line. Okay, gross margin, operating margin, some things like that. And you mentioned it's an energy company. It builds batteries. It has AI, and Kathy Wood loves to talk about autonomous and the size of the market, and the components are there that make it much more than just a car company. Totally agree. And then my counterpoint to that as a trader or as an investor would be, tell me how that is going to drive the bottom line differently. There is no way, I have not seen a cogent argument that says they can achieve the kind of margins that I had of companies I had on the other slide, of Google, of Netflix, of Facebook, anything like that. At the end of the day, they have very high marginal input costs, and they have to lever very high fixed costs with lower variable costs. I phrased that wrong. With lower variable revenue, because it costs a lot to build a car. If they develop autonomous and all the capabilities and some things like that, they can't distribute it among other vehicles and get licensing fees the way that a model that can really scale. So perhaps instead of saying it's just a car company, they just have a different margin structure that I don't see how they're going to change. And that's the key component. That's the most important thing. So, and the fact that there's still a long way to go. I'm trying to pull back to the slide right now. Everything has a price, right? It was up 7-fold on not dramatically different expectations in the market. They didn't, yes, they announced a new factory. Yes, they beat production in a couple of quarters. Yes, they're doing extremely well, but nothing that I could see would justify a 7x increase in the price of the stock. What did justify that is every growth in mutual fund in the world went out and had to own it at least market weight because it was performing well. It did go into the S&P 500 at 1.8%. And retail loves the story and bought it up. So a lot of market factors drove the appreciation that are not expected to continue. And interest rates started to pick up, which makes a stock like this very vulnerable. That's really what it comes down to. I'm not saying anything bad about the company, the product, anything. I enjoy those discussions, but that's not the point of the presentation. Talk a little bit about this. This is some detail about Kathy and 740% increase and how much her assets went up. And she also disagrees. This is an important component as well, the fast money aspect. She says that they're not fast money, they're retail investors. She's doing things differently and people are understanding how she's doing it and recognize it and appreciate it. Great. When you get, what is that math? I can't do that. $46 billion in under a year. By definition, that is fast money. And it will turn around and go as quickly as it came in. Not necessarily, she has to underperform. She has been outperforming. I think she was up 180% last year, but they are chasing performance. When that performance goes away, they'll chase it elsewhere. So that is a vulnerability that could lead to a lot. I think it was a lot of the marginal demand for Tesla over the past year. And it absolutely, if it just doesn't continue to grow, become supply, then Tesla is vulnerable. And that's the only real point to it. She positions herself very heavily in some very high growth, high valuation names, which is fine. It's worked for her extremely well. But it seems that people have sniffed out a vulnerability, and this is one of the things I was referring to, is you can short Teladoc, Square, Roku, Tesla with very reasonable valuation expectations. It just has to return to normal. And to have this kind of a vulnerability exist on the street, that alone could become its own catalyst.
That being that you've got a big player that's over concentrated momentum names.
Yes. And when she becomes a seller, there are a lot of hedge funds that will try and front run her on the way down. They just say, oh, here's a vulnerability. And it's nothing personal. It's just an opportunity in the market. Just like us, they're just looking for a trade. This is a chart of the ARK ETF, and you can see. So I have February 12th highlighted. This is when it came to my attention, and you and I talked about it. I wasn't getting confirmation of the thesis that I had, but it obviously played out in the next few days. And you can see it declined from 156 to 108 in just a couple of weeks. And this is with only fairly modest fund outflows. And this supports the assertion I'll make at the end, but front run is, I don't think we're done on the downside yet. This vulnerability still exists. We just saw the first chapter of that book. And this is more, okay, why now? When did I get involved in this? And this is February 12th. This was a very significant element in that you can see I've highlighted in the box there that the equity fund inflows were $26 billion, the second highest in 20 years. And Tesla was down that week. So that was the week of February 10th, and the stock declined despite the highest, essentially some of the highest fund inflows ever. That simply says, okay, we've got net sellers now. And that was a big component of, okay, now it seems safer to get involved. There were other components that came in, technical, some elements like that, but that to me was a very significant variable.
Yeah, that stands out to me as well.
This is the long-term chart, and what I'm really just highlighting here is the size of the gain. This is $72 at the March low here, and this was 892, I think. We just missed 900. That's a very large gain. Right in here is where it went into the S&P 500, and then there was a derivative follow-on trade that drove it, fairly substantially. What is that? 30%, just from retail, and essentially another version of the GameStop trade. I was hearing some discussion on February 12th that had essentially reversed, but I could not get any confirmation of that. I was looking into put call ratios and talking to some option specialists, and I was not getting any confirmation of it. So we held off until the following Tuesday. It was Monday was off, but we really got involved on February 16th. So this is just the short-term technical analysis showing a pretty defined support level here at 800. And this is where we're starting to get involved. This is February 12th, consolidating at the low end of a trading range, looking vulnerable. And here is how I managed the trade. As I say, I was more active with puts and jumping around a little bit, but this was the common trade that I put on. As I mentioned, here we had the first push below 800. There's some rumors about some of the things going on, discussion of Kathy's vulnerability, but it closed really strong on a Friday. Closed up, went up over that, and then first thing Monday morning was pushing down. I got really lucky and was filled at 805 and just sat with it for a little while. It consolidated below this range. I think my stop was 820. It was right above this level, but never tested. And then we really started to break down a few days later.
Short 805.
Short 805, correct.
Stop above 825?
Yes. So on an $800 stock, that was, I was very comfortable with 20 points of risk, especially this one. This, as we saw yesterday, this thing can move. We had a nice push down and went right through 700, which I thought was going to be some support. I did not cover here. I probably should have. It certainly would have been tradable, but I sat with it. This was my first ad, and what it did is it failed a back test of the 20-day moving average. I was watching that, managing it on a daily time frame, but this is a shorter term chart for some of the detail. Push down, and then I watched it fill out this wedge, which I thought was a great consolidation I was talking about. I was like, okay, and hit it again. This is an increase in momentum, and the story was gaining traction. So I shorted the breakdown again. I got 680 when that went through, and you can see it really accelerated down. So this is 600 was my first target. I think I mentioned that a couple of times. And we went into a strong sell-off. I had a bid in at 611. I wanted to be in front of it and got filled there. And that was half the position. And the next day, quite frankly, I thought I was going to be able to reload on a back test here or something. We got this very powerful flush down, and I had another bid in 575. I left some on the table, but was very, very happy with the trade.
I'd say that's a...
Yes. Now we're going to talk about, so a lot of pieces came together, and this is going to be a longer term trade. Exactly. The skepticism that people said when I said, hey, I think we need to be short Tesla here. The technicals were very clean. I just showed you the chart. It trades very technically, very clean. The 216 bounce, the bounce on February 12th, I'm misspeaking a little bit here, did give me some pause, but when it couldn't hold up there and then rolled over very quickly on the morning of the 16th, I was very happy to get involved. I've been looking for it, and then I did have to be patient for a few days. It just consolidated around 790, 780 for a few days, but then it really accelerated and moved to the downside. Bullet 5 is an important question. We had a very, very strong move off of a very elevated level, and I need to start thinking about, is this a short? I rarely try to really make money on the short side, especially in a bull market, which I think we're very much still in. We're seeing very healthy rotation. Or should I just use this as a source of funds to kind of balance out my market risk, and should I proceed going forward? I'm somewhat of the mindset that this is still an alpha short because my price targets are so much lower, but I need to be careful with that. And yesterday is clear evidence of why. It was up 20% for people who don't know the date. Today is March 10th. But the last bullet to me is the most important. I don't think we're done. I really don't. We're going to talk about here I wish I knew who said this. I've read the 50/80 rule. I don't know where it came from. I don't know how valid it is, but I do know it passes the sniff test. And it just simply says, once a market leader puts in a major top, there's a 50% chance it's going to decline by 80%, and an 80% chance it will decline by 50%. Again, don't know how hard and fast. I have not tested that, but it does pass the sniff test for me. And when you think about some of the stocks that I saw do this, Amazon I have there as the first one, obviously up a lot, but I don't know if people know it declined 95% in the bear market of 2000, 2001. A lot of these others you probably don't even remember, JDSU, AOL, Dell, HPQ, some of these, they were very high growth, very highly valued stocks that declined by 80% plus. And I already talked about the gross margin element. And that's what I mean when I say it makes cars. It's just very hard to grow that bottom line. So everything they have to get is through revenue growth. So the slide here, or the chart here, is my long-term price targets.
I don't find and I don't mean to be critical, but I'm just sharing with you my observation. I don't find the argument persuasive to say Tesla is just a car company.
Okay.
I think you are better served saying, okay, they're more than a car company. You're welcome to disagree with me on this. I just don't find that to be persuasive. I think a better argument and more time in development could be, all right, guys, you think they're more than a car company, fine. And okay, they're going to be able to sell XYZ new products, and okay, that's going to be able to net them 1, 2, 3. Even if they do that, which is a big if, what can this company really be worth? So when you start to say, hey, they're not going to be Google, they're not going to be Amazon, they're not going to be Apple, they're not scalable for certain reasons, that is a good way to, at a very minimum, mitigate your short risk on this particular, at least it mitigates the upside potentially. That's my feedback there.
No, and I appreciate it. Now, what I really am trying to do is just zero in on the gross margin. And exactly as you said, it's like, okay, they're going to make battery packs. They're going to make, they have all these other factors that go in. And I do just return. It's not about the fact that it's a car company.
Have you ever been in a Tesla, by the way?
I have.
Okay.
And it's beautiful. I do. And I've actually thought about buying one, but not at this point. I have nothing against the cars. I think he's doing very important things that are changing the world, and it's certainly generating discussion. And I'm actually a fan of that. I am more skeptical of the cult following and the valuation doesn't matter discussion. And I bring it back to gross margin. I haven't hit it as hard in my discussion as I have in the slides, but every time someone says, okay, but this, the only response I have is like, oh, okay, how is that going to change their margin structure? Okay, it's true. They're going to have autonomous vehicles. How does that change the gross margin structure? So basically what that means is they are going to grow revenues. They're going to have to grow top lines and sell more units. But how are they going to make more money per unit?
I don't really want this to be a counterpoint from me.
Yes.
But I will say that the way that will enable them to make more money is, well, what happens if they get into the trucking business? That enables them to expand. What happens if they get into the Uber business? That enables them to expand, them just being a company that sells cars to consumers.
Yes. And so the Uber business is an interesting one. At the end of the day, and I agree. I don't think it helps the viewers for us to go back and forth on the point counterpoint. I don't know the answer to this question, but how does that change the margin structure? It may change it dramatically. Okay, if it does, what percent of the revenues is it going to be? Because they still have to produce all those vehicles to be into that. So maybe let's make up a scenario here. 20% of their production in 2030 goes into the Uber business, and they make 5 times as much money in that. Okay, they just basically doubled their earnings projections from what I have in 2030. Okay, that's interesting. But maybe it goes, I'm making all this up. I have no projections for 2030 or anything like that. But if their gross margin was 20-ish%, which would be 300 basis points better than any other company in the world, maybe it goes to 25% in that scenario. And that's my only real point is, yes, I hear all these arguments. It's very compelling, and it just doesn't change how they're going to generate profits. That's where I'm hung up. And for a stock to be trading at 24 times revenues, you have very, very significant expectations for profit growth. So, this isn't about I'm right. It's just, it's vulnerable, and a lot of those arguments are priced in.
Okay, good. Well, I like how you're thinking through this trade, not just based on your thesis, but other factors as well. And that's so we don't talk a lot about this, but this a super important point that I want to share here is, so there's different sources of edge in trading. So one of the sources of edge in trading is you find certain setups that you trade well. So, in our world, we might say, let's take momentum trades. And somebody might become a really good momentum trader, measure those results, get good at it, get bigger at it, do it more often, build technology to do more of it, and they build a career out of a strategy which they have an edge in. They personally have an edge in this type of trading. And then there's something called a structural edge. And this is a super important type of edge that we really don't talk too much about, and I don't think a lot of people talk about, which you are alluding to, which is just that this can be a good trade because we've got some people that are just too long. And we've got some people who can get leaned on, and we've got some people who can get front run. And if that starts to happen, then you are going to develop a structural edge in the marketplace from this type of edge. That is a separate edge than any sort of momentum change, which you point out at 800, which there is a momentum change to the downside. Those structural edges are super powerful, and so good to recognize them.
And I think that's a very important point that I didn't talk about enough. I didn't want to get into the Cathie Wood and ARK and some of those things in too much detail. It's just an opportunity there. But you're exactly correct. And I'm far from the only person talking about this. I heard about it from other investors, and it's just being seen as a vulnerability. And how does this not play out in a rising interest rate market with a very highly valued company, with a very highly concentrated position, with a lot of very fast money flows? There's just way too many ways for this to unwind. And if players who need to put money to work on the short side, hedge funds who need to be market neutral or want to offset some of their risk, and had a really tough time on the short side last year, this looks like a fat pitch. And the more that people talk about it and say, look, all we have to do is lean on it, and how am I wrong? They sell more cars in 2025. It feels like and this is one of the things I want to be very careful in how I characterize it here, but it just feels like a safer short. All the risks normally apply, but there's just a lot of opportunity. And tell me how I go wrong in 2021 with Tesla. Yes, they can sell more this quarter or next quarter, but that doesn't really change the thesis that I have, that there's too much money that piled into it. And one of the bullets in the slides was, who's the marginal buyer? And let me spend just a moment on that. I know that Saudi Aramco, which is the Saudi oil company, bought shares in Tesla as a hedge against EVs growing. International players own it for various reasons. Growth funds, I've seen the data. It is extremely heavily weighted in just about every growth fund out there. It wasn't in the S&P 500, but it was a large weighting in a lot of the growth indexes. And the way that players generate alpha is they have to own more than the index. This is for a mutual fund. They have to have an overweight rating. So it's a heavily overweighted, overowned stock. And then when it into the S&P 500, that was obviously the largest source of marginal buyers. Just the S&P 500 index funds, which have trillions of dollars in assets under management, had to buy in at a 1.9% weighting. Even some value funds own this. And retail, of course, owns it a lot. So when you think about, okay, it pulled back from 800 to 700, who's on the sideline waiting to rush? Oh, and the last thing would be short interest. Short interest, which had run around 20%, had dropped to 3% at the time of the trade. There wasn't even pent-up short interest on the sidelines to rush in and cover and take advantage of it to hold the stock up. So that was very much a part of the thought process too. Potential large short seller, No real demand sitting on the sidelines. And I haven't talked about valuation in that little bit. But then you have the valuation cushion. It's like, okay, it could come back 50% and still be a very highly valued company. So a little bit of a tirade there. Want to just wrap up with the price targets and pointing to the 80-50 rule. I did notice that this consolidation, which looked really healthy and went through most of the fourth quarter, is right at 440, which is almost exactly 50% off of the high. There's a high volume node, a lot of trading elements that can draw it here. And if things get really crazy, it wouldn't shock me to see it pull back to 160. But my first targets were 600, which we saw last week. Second target was just the 200-day moving average. That's how far we were stretched on some trading metrics. We were 30% above the 200-day moving average. That's it. We hit that already. And then the 50% pullback is my longer term target. I'll really take a lot of weight off here, but that's what I'm looking for. And I think that could happen within the next month or two.
All right, Trey, really appreciate you putting this together. Very interesting research here, and obviously a battleground stock, and we will see how it goes.
I'm going to try and stick to the rule of don't read the comments when this one goes in.
True.
I do expect some controversy.
Hey, go ahead and click our subscribe button so you don't miss any of the videos that we're producing for you in the trading community. And please take the time to add your feedback in the comments section for what videos you'd like for us to produce next and what you found helpful from this video. From all of us at S&B, train and trade well.